Hey everyone, welcome back to Zenova. So now I'm going to show you the floating rate note portfolio, and just like the callable puttable bond portfolio, the note portfolio is really the same as the fixed rate bond portfolio in that you go to the trade editor, you can create new trades, you can post new trades. It will be the same thing down in the portfolio, just like the previous two bond portfolios I showed you, the fixed rate bond and the callable bond. Same methodology in creating new portfolios. So I would say to go over the fixed rate bond portfolio overview, the actual video to show you how to create portfolios instead of going through that again. But the only difference is going to be in the floating rate note portfolio. You'll be selecting two underlying curves. Because when you're pricing a note, you're actually using a floating curve instead of a fixed rate or a coupon. It's going to float. And you're going to be also selecting a curve to present value or discount back the cash flows. So normally it would be that you would select the same curve for both the forward curve and discounting back. But in Zenova, you can certainly, if you would like, use one curve for determining what the coupons are going to be, the floating curve, and an entirely different curve to actually discounting back those cash flows. So once those curves are selected, you would just simply calculate. And we do go through the iterative process to show you as the price of the note moves, what the new yield is going to be. All the output is here. You can post that trade as a new trade to an existing portfolio or create a portfolio right down here. The portfolio will actually show in the grid, and again, you have both inputs that have been saved in the database when you initially created a trade, and the outputs after calculating are all generated here. So you can see the sensitivity of all your notes, and you can see the grid being totaled up with averages in the yellow star here of duration, convexity, average life. You can see the price of the note, value, OAS, option adjusted spread, Z-spread, and in this case it's a dollar value I have here of the sensitivity of a 1 basis point shift to the curve, to the forward curve. Same thing, overrides I can price as of today, or I can select in the calendar a date I want to use for pricing. I can have the flexibility of when I'm doing a dollar value of the basis point, make it a 1 basis point shift or 100 basis point or 1% shift, recalculate. And you can see now my dollar value has gone to 110. Sensitivity on notes is very low because it's not a fixed rate and the notes are the coupons are basically the floating rates. I could, if I'd like to, go into and change either a spread I want to put to the curve, to the floating, or a spread that I'd like to put to the discount curve, or completely change the underlying curves to the portfolio pricing just from the existing floating curve that I'm inputting here in the override, or a combination of a floating and a new discount curve that I want to apply to the entire portfolio. And I can, if I want, actually look at that curve. So once you do that, that will give you the ability to do the what-if analysis on the entire portfolio, and then when you recalculate, you're going to get all new values and the totals will show up here.